The term property, plant, and equipment in accounting refers to tangible assets that are depreciable, though it includes land which is normally not depreciable. The IS 16 is an accounting standard adopted by the International Accounting Standard Board that prescribes the accounting treatment for property, plant, and equipment. These are the examples of assets that we treated previously while dealing with the conceptual framework for financial reporting standards, covering the definition and recognition of assets into accounting books. We have also debited and credited entries affecting the assets accounts in the general ledger. The scope of IS 16 deals with the following: the depreciable tangible assets like property, plant, and equipment, hereafter referred to as PPE. These are assets that will be recognized into accounting books on condition that it is probable that future benefit will flow to the enterprise from the asset, meaning that the use of the asset will generate an income for the entity, and that the cost of the asset can be measured reliably. In other words, the asset in use should have a monetary value. Secondly, the IS 16 statement recognizes PPE at historical cost. The historical cost of PPE will include the purchase price, being the price paid to acquire the asset, the installation costs paid to make the asset ready for use, the legal cost incurred in the registration of the asset, and all other costs incurred to acquire the asset, excluding VAT. Thirdly, the IS statement allows an item of PPE to be shown at book value or carrying value, as well as the revalued amount on the financial statements. The carrying value of PPE will be calculated by deducting the total depreciation over the useful life of an asset from the historical cost. Land has an unlimited life, therefore doesn't require depreciation. Any upward revaluation will be credited to the revaluation reserve, while the downward revaluation will be treated as an expense to profit and loss account. Fourthly, the IS 16 statement allows for the derecognition of PPE. PPE will be derecognized when there are no future benefit expected from the use of an asset. This happens when the maintenance cost exceeds the income generated by an asset. The statement therefore provides accounting entries to record the derecognition through the disposal. Lastly, the IS 16 statement makes provision for the disclosure of PPE on the statement of financial position. The following items will be disclosed on the financial position statement: the method used for the depreciation, the total cost less the accumulated depreciation, the reconciliation of the carrying value at the beginning and at the end of the year, showing all the movements that occurred during the year. In addition to the requirement of the IS 16 statement, we will prepare the asset register for every PPE held by the enterprise. The IS 16 statement deals with property, plant, and equipment, which in accounting are classified as non-current assets. It is proper that at this stage, I introduce the two categories of assets, being the non-current assets and the current asset, which falls outside the scope of IS 16. The characteristics of non-current assets are that they are used for long term, they are costly in acquiring them, and they are acquired for investment purposes. Non-current assets are also tangible, meaning they are physical in nature. Examples are the land and building that is used for business purposes, the plant and machineries that are used in the factories, the equipments including furniture and fittings, vehicles and trucks. Non-current assets are also depreciable, in exception of land and long-term investments. Non-current assets are also intangible, meaning they are not physical in nature and they are neither depreciable. Examples are the trademark, the trade name, copyrights, and the patent rights. For the current assets, the characteristics are they are used for short term, they are less costly, they are frequently replaced, and they are bought for trading purposes. They may or may not be tangible. Some of the examples are the bank account, the trading inventory, the accounts receivable, cash flows, petty cash, and so forth. The IS 16 allows an item of PPE to be shown at book value or carrying value. This slide introduces you to the terms and terminology associated with the calculation of carrying value. The carrying value is the measurement at which PPE is shown in the statement of financial position at the end of the financial period and is calculated by deducting the total depreciation referred to in accounting as accumulated depreciation from the historical cost of PPE. While the depreciation reflects the loss of an asset production potential over the period of use, or depreciation represents a systematic allocation of the cost price of PPE to the profit or loss and comprehensive income statement. The estimation of the useful life of PPE is critical and must be determined at the initial stage. The depreciation will then be calculated using the historical costs of PPE, the residual value known as the salvage value, which is the estimated value of an asset at the end of its useful life. The depreciable amount calculated as historical costs less residual value, the estimated useful life of an asset, the expected dismantle cost that will be incurred at the end of the useful life of PPE, the method of depreciation that will be adopted by the entity. For our scope of work, we will be looking at the straight line and the diminishing or reducing balance method. It is therefore imperative that the depreciation should be charged annually over the useful life of an asset and to update the asset register with the entries. Let's look at how an asset register will be kept throughout the useful life of PPE to determine the carrying value at the end of each financial period while the asset is generating an income for the entity. In this example, a buggy was bought by an entity for deliveries. On the day of the purchase, the following accounting entries were made into the records. The vehicle account as an asset was debited, while the bank account was credited. If the vehicle was bought on account, the accounts payable will be credited with the entry. Thereafter, an asset register will be compiled showing the following details: the asset description, the serial number allocated to the asset, the registration number, the date of purchase, in this case 31st of December 2008, the depreciation method. We will be using the reducing balance method or diminishing balance method. The useful life estimated at the initial stage as 5 years. It means therefore that the depreciation to be written off will be 20% per year. The salvage value also estimated at the initial stage, 59,000 rand. In addition, the register will also reflect the date of use of the asset, the cost price, the salvage value, the depreciable amount, the depreciation, which is an expense in accounting books, which will be debited with the entry in the general ledger, the carrying value of the asset that will be reflected on the statement of financial position on an annual basis, the accumulated depreciation representing the total depreciation that has been written off over the useful life of an asset, which will be credited in the general ledger to complete the double entry system of the depreciation transaction. Then on an annual basis, the carrying value will be reflected as follows on the asset register. The asset was put into use from January 2009, and it was used for a full period of 2009. Therefore, at the end of 2009, after 12 months of use, the depreciable amount will be calculated as 250,000. In the first year, when we are using the reducing balance method, the cost price or historical cost and the depreciable amount is the same amount. We therefore ignore the salvage value that was estimated. In this case, in the first year, the depreciation will be calculated as 20% of 250,000, giving us the depreciation amount of 50,000, deducting it from the depreciable amount, showing us or giving us an amount of 200,000, which will be the carrying value that will be reflected on the statement of financial position, while the accumulated depreciation at the end of the year will be reflected as 50,000. In year 2, after the vehicle has been used for the full term of 12 months, the depreciable amount will be calculated as 200,000, which is the carrying value of the previous year. 20% of 200,000 gives us the depreciation of 40,000 in year 2, deducting it from the depreciable amount of 200,000 to arrive at the carrying value of 160,000, with a total accumulated depreciation of 90,000. At the end of the third year, the depreciable amount will be calculated as 160,000, which is the carrying value of the previous year. 20% giving us the depreciation of 32,000, deducting it from 160,000 to arrive at the carrying value of 128,000, with a total accumulated depreciation of 122,000. In year 4, after 12 months of use, the depreciable amount will be calculated as 128,000, multiplying it by 20% to arrive at the depreciation amount of 25,600, deducting it from 128,000 to arrive at the carrying value of 102,400. After 4 years of use, on the statement of financial position, the vehicle will be reflected at a value of 102,400, with a total accumulated depreciation of 147,600. In year 5, 2013, the asset was also used for the full period of 12 months. The depreciable amount will be calculated as 102,400. 20% depreciation being 20,480, deducting it from the depreciable amount to arrive at the carrying value of 81,920, with a total accumulated depreciation of 168,080. Note that the asset has reached its full term of useful life. At this stage, the carrying value at the end of its useful life was supposed to give us 0, but it gives us an amount of 81,920. This amount in accounting is the amount that is referred to as the residual value. That is why we ignored the initial residual value, which was indicated on the asset register, because when we are using the reducing balance method, it calculates or determines its own residual value at the end of the useful life of an asset. Also, I want to draw your attention to the depreciable amount column and the depreciation column. Note that the amounts from year 1 to year 5 were declining. That is why this method is referred to as the reducing balance method, because each year the depreciable amount will reduce as the depreciation reduces. The other thing is that IS 16 allows the entity to derecognize the asset at the end of its useful life. At the end of its useful life, the entity therefore decided to sell the vehicle for 93,000 rand cash. The depreciation transaction will be accounted as follows in the accounting books. In year 1, the depreciation was calculated as 50,000 rand. The depreciation account will be created in the general ledger, and at the end of 2009, it will be debited with the details reading as accumulated depreciation posted from the general journal, the amount 50,000 on the debit side. This entry will be posted to the credit side of the accumulated depreciation at the end of 2009, with the contra reading as depreciation posted from the general journal, the entry 50,000 rand. Immediately, the depreciation expense account at the end of 2009, it will be closed off to profit and loss on the credit side, while the accumulated depreciation account will be closed off by determining the balance carried down on the debit side, which must be carried over to the credit side as opening balance in 2010. In year 2, the depreciation was calculated as 40,000 rand. This entry will then be recorded on the debit side of the depreciation account at the end of 2010. It will be shown as accumulated depreciation from general journal, the entry 40,000. In the accumulated depreciation account, the entry will be credited at the end of 2010 as depreciation posted from the general journal, the amount 40,000. Note that the accumulated depreciation has got two entries. The first entry was done at the beginning of the year as a balance brought down. The second entry is the current depreciation at the end of 2010. The amount 40,000. The depreciation expense account will therefore be closed off at the end of 2010 to profit and loss on the credit side, while the accumulated depreciation will be closed off by calculating the balance carried down on the debit side, which must be shown on the credit side as the opening balance for 2011. In year 3, depreciation was calculated as 32,000 rand. This entry will be shown on the debit side of the depreciation at the end of 2011. The same entry will be credited to the accumulated depreciation at the end of 2011. The depreciation expense account will be closed off to profit and loss at the end of 2011, while the accumulated depreciation will be closed off by determining the closing balance on the debit side, which will be carried over as the opening balance in 2012 on the credit side. In year 4, depreciation was calculated as 25,600. This entry will be reflected in the depreciation expense account on the debit side at the end of 2012 as accumulated depreciation amount 25,600. The same entry will be credited to the accumulated depreciation at the end of 2012 as depreciation posted from the general journal. The expense depreciation account at the end of 2012 will be closed off to profit and loss on the credit side, while the accumulated depreciation will be closed off by calculating the closing balance on the debit side, which will be carried over to the credit side as opening balance in 2013. In year 5, we calculated depreciation as 20,480. This entry at the end of 2013 will be shown in the depreciation account as accumulated depreciation posted from the general journal, the amount 20,480. The same entry will be credited to the accumulated depreciation at the end of 2013, and it will be shown as depreciation 20,480. The expense account depreciation will be closed off at the end of 2012 to profit and loss on the credit side, while the accumulated depreciation account will be closed off and the asset will be derecognized because it has reached its full term of useful life. When derecognizing or disposing of the asset, the following steps should be followed. Firstly, determine the cost price of the asset that is disposed of. In the example, we are disposing of the asset which was recorded in the asset register at an amount of 250,000 rands. Secondly, determine and calculate the total accumulated depreciation over the number of years in which the asset was used. We have calculated from the asset register the total accumulated depreciation of 168,080 rands. The third step will be to consider the disposal. Is the asset disposed for cash? Then the bank account will be affected. If it is disposed on credit basis, then it will affect the accounts receivable. If the asset is being traded in for a new asset, it will affect the accounts payable. Or if the asset is scrapped off, then the loss on disposal account will be created in the general ledger. In this case, the asset, according to the asset register, was sold and the entity received a cash amount of 93,000 francs. The last step will be to consider whether the business is realizing a gain or a loss with a disposal. This will be determined by deducting the carrying value from the proceeds of the disposal. In this example, the asset was sold for 93,000 and the carrying value on the asset register was calculated as an amount of 81,920. The proceed is greater than the carrying value, therefore the business is realizing a profit on disposal with this transaction. The above steps can be translated as follows into accounting records. We are disposing of an asset or a vehicle that cost 250,000 francs. In the general ledger, the vehicle account reflects the opening balance at the beginning of 2013 of 550,000 francs. These are the total vehicles that are owned by the entity, including the vehicle that is being disposed of. The accumulated depreciation account reflects an opening balance of 247,600, which also includes the opening accumulated depreciation for the asset that is being disposed of. Because we are disposing the asset disposal account will be created in the general ledger. Then the following steps will be followed. Step number 1 will be to transfer the cost price of the vehicle into the asset disposal account. We will therefore create general journal entries where the vehicle account will be credited with the asset disposal, posted from the general journal. The amount is the cost of the vehicle that is being disposed of, which is 250,000. To complete the double entry system, we will debit the asset disposal with the contra on the same date reading as vehicle, posted from the general journal, the total amount 250,000. The second step will be to calculate and thereafter transfer the total accumulated depreciation of the asset that is being disposed of to asset disposal account. We will therefore first reflect the fact that the asset that we are disposing was used in the current year. We have used it for a period of 12 months. We will therefore calculate the depreciation for the full period of 12 months using the diminishing balance method. We've calculated it as 20,480. This current depreciation will be added to the opening balance of the asset that is being disposed of. Previously, the total accumulated depreciation was calculated for 4 years of use as 147,600. To this total, we will add the current depreciation to arrive at a total that must be transferred out of the accumulated depreciation of 168,080. This total will then be transferred by debiting the accumulated depreciation with the asset disposal on the same date and crediting the asset disposal with a contra of accumulated depreciation posted from the general journal, total amount 168,080. The third step for the disposal will be to consider the disposal. The business is receiving 93,000 cash. The bank will therefore be debited with the amount, while the asset disposal account will be credited with a contra of bank posted from the CRJ, total amount 93,000. If the asset was sold on credit, the contra will not read as bank, it will read as accounts receivable, posted from the general journal. If it was a trade-in transaction for a new vehicle, the asset disposal on the credit side will be reflected as accounts payable, posted from the general journal. If the asset was scrapped off, on the credit side of the asset disposal, the entry will be shown as a loss on disposal. The third and last step on the disposal will be to determine whether the business is making a gain or a loss. That will be determined by balancing off the asset disposal account. We will therefore close and balance off the asset disposal. The credit side is the biggest side. We will therefore close it with a total of 261,080. Calculate the missing figure on the debit side. Show it as a profit on disposal. Create an account called profit on disposal of assets. To complete the debit, you will credit it on the same date with the description of asset on disposal posted from the general journal, the amount 11,080. Immediately the profit on disposal of asset will be closed off to profit and loss. Therefore, the details will read as profit and loss posted from the general journal 11,080. Your asset disposal account has been closed off. Your profit and loss on disposal of an asset has been closed off. Closing off your vehicle account, calculating the closing balance, showing it as the opening balance in the following year. We do the same thing also with the accumulated depreciation, but when we look at the accumulated depreciation, it only shows the opening balance in the accumulated depreciation account and the current depreciation on the vehicle that is being disposed of. At the moment, the business also had the vehicles worth of 300,000 that were used in 2013. We will therefore have to calculate the depreciation on the remaining assets in the business by using the diminishing balance at 20%. We will therefore take the remaining balance, deduct the opening accumulated depreciation only on the remaining balance of the vehicle, and the accumulated depreciation on the remaining balance is 100,000. We will deduct it to arrive at the depreciable amount of 200,000, multiply it by 20% to arrive at the depreciation of 40,000. We will therefore close off the accumulated depreciation by balancing it off with the closing balance, which will be reflected in 2014 as the opening balance of 140,000. The 140,000 is the total accumulated depreciation only on the remaining vehicles. Complete the asset register given below and prepare all the general ledger account as required by the exercise.